I've been watching Warren Buffett accumulate cash for the better part of 7 decades now, and every time he does it, people ask me the same question. Charlie, what does Warren know that we don't? Is something terrible about to happen? Let me tell you something that might save you a fortune. Warren doesn't hoard cash because he is predicting disaster. He hoards cash because he is preparing for opportunity, and there is a massive difference between those two things that most people completely miss. I remember back in the early 2000s, Berkshire was sitting on $40 billion in cash. Everyone thought we'd lost our minds. The dot-com bubble was roaring. People were making millions on companies that had never earned a penny. And there we were, sitting on cash like a couple of old fools. Reporters called us, shareholders complained. Some people said Warren had lost his touch. Then 2008 happened. The world nearly ended. Banks were failing. Credit markets froze. And you know what Warren did? He deployed that cash at prices we could never have imagined. Bank of America, Goldman Sachs, General Electric. Deals that made us billions while everyone else was scrambling to survive. That is what cash is really about. It is not about fear. It is about positioning yourself so that when the world panics, you can be rational. When everyone else needs to sell, you can buy. When credit disappears, you have it. Right now, as I'm speaking to you, Berkshire's cash position is larger than it has ever been in history. Over $150 billion just sitting there. And people are asking the same questions they always ask. What does this mean? What is coming? Let me walk you through exactly what Warren and I see when we look at markets today, why we're holding so much cash, and what this might mean for anyone trying to protect and grow their wealth in the years ahead. Because understanding this could be the difference between prosperity and disaster for your family. The first thing you need to understand is valuation. Warren and I have a very simple philosophy. We will not overpay for anything, no matter how wonderful it is. Price is what you pay. Value is what you get. And right now, the prices being asked for most businesses simply don't make sense. Think about it this way. Back in the 1970s and early 80s, when we were building Berkshire, we could buy wonderful businesses at 8 or 9 times earnings, sometimes 6 times earnings if there was temporary trouble. Companies with strong competitive positions, good management, predictable cash flows, and we could buy them cheap today. The S&P 500 is trading at valuations that would have been considered absurd 20 years ago. Companies with no earnings, no competitive advantages, no proven business models, trading at 50 times sales, not earnings sales. It is madness, pure speculative madness driven by cheap money and collective delusion. Now, I know what people say, but Charlie, interest rates are low. That justifies higher valuations. And there is some truth to that. When Treasury bonds yield 3%, stocks yielding 4 or 5% look attractive by comparison. But that logic only works if the earnings are real, sustainable, and not dependent on continued access to cheap credit. Here is what worries me. We've had over a decade of basically free money. The Federal Reserve has kept interest rates artificially low since the 2008 crisis. And what happens when money is free? People do stupid things. They leverage up, they chase yields, they buy businesses and assets at prices that only make sense if nothing ever goes wrong. I've seen this movie before. Multiple times in the late 1920s, in the late 1960s, in the late 1990s. In 2007, every time it is the same pattern. Easy money, rising asset prices. Everyone convinced that this time is different. And every single time it ends the same way. Badly, Warren isn't sitting on cash because he knows when the crash is coming. Nobody knows that. What Warren knows is that when you can't find anything to buy at sensible prices, you wait patiently. Because opportunities always come, always. Markets go through cycles, fear and greed, panic and euphoria. And when the panic comes, those with cash can do extraordinarily well. Let me give you some specific numbers to illustrate what I'm talking about. In 2009, right at the bottom of the financial crisis, Warren was buying stock in Bank of America at $7 per share. Today it trades around $30. He bought Goldman Sachs preferred shares that paid him 10% annually, plus warrants to buy common stock. He invested $5 billion in Goldman and ended up making over $3 billion in profit. You can't make those kinds of investments when markets are calm and prices are high. You can only make them when there is blood in the streets and everyone else is terrified. But to take advantage of those opportunities, you need two things. You need capital and you need courage. Cash gives you the capital. Preparation gives you the courage. Now, let's talk about what I see in the markets today that concerns me. First, corporate debt levels are at all-time highs. Companies have borrowed trillions of dollars to buy back their own stock, fund acquisitions, and pay dividends. In a low-interest rate environment, this looks smart. You borrow at 3%, earn 8% on your equity. Wonderful. But what happens when rates rise? What happens when earnings decline? What happens when you need to refinance that debt and credit markets aren't cooperating? I remember the savings and loan crisis in the 1980s. Hundreds of financial institutions failed because they'd borrowed short and lent long. When interest rates rose, their business models collapsed. The government had to step in with massive bailouts. Could something similar happen with corporate America? I don't know, but the vulnerabilities are there. Second, I'm concerned about speculative excess in certain sectors, cryptocurrencies, SPACs, meme stocks. Companies with no earnings trading at astronomical valuations based purely on stories and momentum. This is classic bubble behavior, and bubbles always pop. The question isn't if it is when, and how bad the damage will be. Third, I worry about the withdrawal of monetary stimulus. For over a decade, central banks around the world have been printing money and buying assets to prop up markets. What happens when that support is withdrawn? What happens when quantitative easing becomes quantitative tightening? We got a preview in late 2018 when the Fed tried to normalize rates and shrink its balance sheet. Markets dropped 20% in a matter of weeks. The Fed reversed course immediately. That tells you something important. Markets have become addicted to easy money. Like a heroin addict, they can't function without it. And when you try to take it away, they go into withdrawal, violent, painful withdrawal. At some point, the central banks will have to choose between continued inflation or market pain. Neither option is pleasant. Fourth, I see significant geopolitical risks that markets seem to be completely ignoring. Tensions between the United States and China, political instability in Europe, massive government debt loads that will eventually have to be dealt with. Any one of these could trigger a major market disruption. And when you combine them all, the probability of some kind of crisis becomes quite high. Now, I want to be very clear about something. I'm not predicting imminent disaster. I've never been good at predictions, and I don't make money by predicting. What I'm saying is that the risk-reward ratio in most investments today doesn't make sense. When you're being asked to pay very high prices for uncertain future cash flows in an environment filled with risks, the smart move is to wait. Let me tell you what Warren does when he can't find good investments. He doesn't force it. He doesn't buy marginal businesses just to put money to work. He waits, and while he is waiting, he accumulates cash. Not because cash is a great long-term investment. It is not. Inflation eats away at cash over time, but cash gives you options. And in uncertain times, options are valuable. Think about it this way. If you're fully invested when a crisis hits, what are your options? You can sell at terrible prices, you can hold and watch your wealth evaporate. Or you can panic. None of those are attractive, but if you have cash, suddenly you have incredible power. You can buy wonderful businesses at bargain prices. You can make deals that others can't. You can sleep at night while everyone else is terrified. I've watched Warren operate this way for over 60 years. He is not timing the market. He is positioning himself to take advantage of Mr. Market's emotional swings. When Mr. Market is euphoric and offering silly prices, Warren sells or sits on cash. When Mr. Market is depressed and offering businesses for less than they're worth, Warren buys aggressively. It is simple. Not easy, but simple. Now, let me address what I think you should be doing with this information, because knowing that Berkshire is holding cash doesn't help you unless you apply the lesson to your own situation. First, look at your own asset allocation. Are you fully invested in stocks at all-time high valuations? If so, why? Is it because you carefully analyzed the risk-reward ratio and concluded these are good investments? Or is it because everyone else is doing it and you don't want to miss out? Be honest with yourself. FOMO, fear of missing out, is not an investment strategy. It is a path to losing money. Second, think about building your own cash reserve, not for emergencies. You should already have that. I'm talking about opportunity cash, money set aside specifically to deploy when attractive investments appear. How much? That depends on your situation, but having some dry powder means you can act when others can't. Third, raise your standards. Don't buy businesses or investments just because they're going up. Buy them because they make sense at the price you're paying. Can you understand the business? Does it have a competitive advantage? Is the management honest and capable? Are you paying a reasonable price relative to the cash flows you'll receive? If you can't answer yes to all of these questions, don't invest. Wait for something better. Fourth, prepare yourself psychologically for volatility. If you own stocks, they will go down. Maybe 20%, maybe 50%. Are you prepared for that emotionally? Can you hold through a major decline without panicking? If not, you shouldn't own stocks at all. You should be in treasury bonds or cash, because the worst possible outcome is buying stocks at high prices and then selling them at low prices out of fear. Let me share a personal experience that illustrates this point. In 1973 and 74, I watched my net worth decline by about half. Businesses I thought were wonderful got cut in half, then cut in half again. It was brutal, painful, but I didn't sell. I held on, and in some cases I bought more. By 1975, those investments had recovered and gone on to make me a fortune, but only because I had the psychological fortitude to endure the drawdown. If you're not willing to go through that kind of experience, you have no business owning stocks. Stick with something safer. There is no shame in that. The shame is in taking risks you don't understand and can't handle emotionally. Now, let me talk about what might trigger the next major opportunity, because that is what Warren is really waiting for. Not disaster for its own sake, but the opportunity that disaster creates. It could be a recession. We're overdue for one. The last recession ended in 2009. That is over a decade of expansion. Historically, expansions don't last much longer than that. Eventually, some shock hits the system and growth turns negative. Corporate earnings decline, stock prices fall. That is when opportunities appear. It could be a credit crisis. With so much corporate debt outstanding, a wave of defaults could freeze credit markets like we saw in 2008. If companies can't refinance their debt, they fail. Their stock prices collapse. Distressed debt becomes available at pennies on the dollar. That is when someone with cash can make extraordinary returns. It could be a geopolitical shock, a war, a pandemic worse than COVID, a major cyber attack, something that disrupts the global economy and sends investors fleeing to safety. Again, those with cash can step in when prices have been slashed, or it could be something completely unexpected, some risk that nobody is even thinking about right now. That is the nature of crisis. It usually comes from where you're not looking. The important thing is to be prepared regardless of what specific form it takes. Here's what I know with certainty. At some point in the next few years, there will be a major market disruption. I don't know when. I don't know what will cause it, but it will happen. Markets always go through cycles, and when they've been rising for over a decade on easy money, the eventual decline is usually severe. When that happens, Berkshire will be ready. We'll have cash. We'll have courage. We'll be able to make investments that create value for decades to come. The question is, will you be ready, or will you be one of the people who has to sell at exactly the wrong time because you're overextended and panicked? Let me give you some final thoughts on how to think about this. Warren, accumulating cash is not a market timing call. It is a discipline. When prices are high and opportunities are scarce, be patient and preserve capital. When prices are low and opportunities are abundant, be aggressive and deploy capital. This isn't complicated, but it requires tremendous psychological discipline that most people don't have. The hardest part is sitting on cash while everyone around you is getting rich. In 2006, 2007, we were sitting on $40 billion while real estate was doubling, and everyone was flipping houses. People thought we were idiots. Then 2008 happened, and suddenly we looked like geniuses. We weren't geniuses, we were just disciplined. Same thing in the late 90s with the dot-com bubble. We refused to buy internet stocks at crazy valuations. Our performance lagged, shareholders complained. Then 2001 happened, and those companies went to zero, while we survived and thrived. So when you see Berkshire holding record amounts of cash, don't panic. Don't think disaster is imminent. Think of it as Warren being disciplined, refusing to overpay, waiting patiently for the fat pitch. And when that pitch comes, he'll swing hard. You should be doing the same thing in your own life. Don't chase, don't speculate. Don't convince yourself that this time is different. Build cash, raise your standards, wait for quality at reasonable prices, and when the inevitable panic comes, be ready to act while everyone else is frozen in fear. That is the real lesson from Berkshire's cash position. It is not a prediction. It is preparation, and preparation is what separates those who build lasting wealth from those who get wiped out every time markets correct.